Hello Sector Watchers, welcome to the show. This is the 50th episode of Sector Spotlight on Tuesday, the 29th of September, recorded on the 28th. My name is Julius de Kempenaer and as usual I'm your host for today's show. I love to hear from you, so if you watch the show on YouTube, please don't forget to like the video and share your thoughts, ideas, suggestions, etc. in the comment section. I'm always in the lookout for new ideas that I can cover in an upcoming episode of Sector Spotlight. So don't be shy, your feedback and your questions are appreciated and I will answer them personally. We're heading towards and into October this week. So we'll have the usual update on asset class and sector rotation, and then we'll have our monthly look at seasonal performance for sectors. And this month there are a few interesting observations to make from that seasonal perspective, and that's both on the positive and the negative side of the equation. Stay tuned and we'll start right away. Rotations during last week were, as we discussed previously, I called them erratic, and I think that's still the word when we look at the relative rotation graphs showing rotations for sectors and asset classes. Let's start with the asset classes on the left hand side of the screen. If we look at the table, we can see that it was a very good week for the dollar index, gaining 1.9%, and actually a very bad week for commodities. Both the commodity ETFs that we track, GSG and DJP, lost 2.6 and 3.5%. If we stick more to the core, to the benchmark VBINX, then we see stocks, ITOT, losing 0.8%, and government bonds are 0.3%. And exactly as I explained last week, the VBINX index consists not only of government bonds but also holds corporate bonds and high yield, and you see that especially these segments, these asset classes are dragging the performance for VBINX down 0.9%. If we look at the rotations over the last 5 days, then 1, 2, 3, 4, 5. This is last week Monday, and this is the rotation 1, 2, 3, 4, 5 through last Friday, the 25th. And you can see that GSG actually rallied relatively while DJP came down, and that is a good example of the fact that the tails on RRG are showing trends in relative strength, and that does not necessarily always match with pure performance or even over or underperformance. You see that the tail on GSG actually moved higher, moved up into the leading, into the improving quadrant towards leading, and you see that it was one of the worst performance in terms of price and relative performance. So we'll have to see how that trend evolves. If we stick with stocks and bonds, then we see that the stock market, again, I described it as erratic last week, and that was because at that time stocks just moved into the lagging quadrant and then they immediately start to move up. And that's what we've seen pretty much, especially towards the end of the week, that stocks started to really improve at the cost of government bonds, which we saw rolling over while inside the leading quadrant. So for the short term, it's back to stocks and out of bonds, basically getting in line with the longer term picture that we'll have a look at later on. If we move over to the to sectors, then we have here the situation of last Friday, and if we scroll that back, well, you can see here it's a good example how big the spread of the performance between those sectors is, because we had technology of all sectors moving up 2.2% and leading the way higher, followed by utilities at 1.2, discretionary almost unchanged, and communication services almost unchanged, but SPY was down 0.6%, so that's why these are all above and they're all outperforming SPY in that week. Here again you see that XLK technology is inside the lagging quadrant, but it's actually the leading sector. that trend, that relative trend on that daily time frame was down, but it seems that that is now rapidly improving, because shortly after entering the lagging quadrant, XLK started to move up, moved up almost vertically higher, rapidly gaining in relative momentum. Not yet on the RS ratio scale, but if that momentum continues, then it's almost a given that it will also pick up on the RS ratio scale. What I wanted to see is the big difference in performance. Tech, as I said, 2.2%, but look at energy, down 8.7%, the weakest sector for the week, and let's face it, the weakest sector for as long as I can remember. I actually am going to look if energy was ever, in the almost 1 year that we're doing Sector Spotlight now, has ever moved A, to the right side of the graph, and B, was called as a good sector. I cannot remember it. As a matter of fact, right now it's the worst sector on the plot once again. Also, materials didn't do very well. Financials rolling over. Industrials, real estate, and here healthcare, they're less of an underperform, but you see that these underperformances are quite significant if you compare it to the performance of the S&P 500. Let's look at the longer term picture and put those two into perspective. So let's start quickly with the asset classes. Here is stocks, US stock market, core S&P, inside lagging on the daily but curling up. And let's find that, we need to load asset classes then. Let's load up ITOT here. It's inside the leading quadrant, rolling over a little bit. That is almost certain, because we had this rotation from leading through weakening into lagging, and that is now, with a little bit of a delay, making its way to the weekly RRG. But look at the position of ITOT on the RS ratio scale. It's the furthest to the right. It's the strongest sector in terms of RS ratio, and there is plenty of space for ITOT to roll over and curl back up without hitting the lagging quadrant. So stocks on the longer term time frame, as we discussed over the last few weeks, still remain preferred over government bonds. Quickly go to the government bond. We see the opposite rotation. On the daily, we see the tail a little bit more pronounced, moving downward while inside leading. And here on the weekly, we see government bond inside lagging and starting to curl up. Again, the longer term picture, government bonds are way down to the left, stocks are way down to the right. That means an overweight or a preference for stocks over government bonds. If we look at the commodity tails, we see the improvement continuing. So on a relative basis, they're doing pretty good at the moment. If we look at the charts for commodities, I'm still not convinced. They're bouncing against old support levels that were once broken and now starting to act as resistance, and that will probably keep both these commodity ETFs under pressure in the weeks to come. Let's have a look at the charts that come with it. Let's do the sector comparison first. So this is the daily, and if we then do the sectors here on the weekly, daily, weekly, and let's sort them here. Let's do it on performance, why not? Consumer discretionary, daily tail, inside weakening, very short tail, and if we bring up consumer discretionary here, you see that it is inside leading. Look at this, the shortness of that tail. That tells me a lot. It tells me that that is a very stable sector, very stable rotation. So this consumer discretionary remains one of the better sectors inside this universe. That is one thing that is for sure. Doing that wrong. I need to go to my dashboard and my chart list and go to sector spotlight, and then I want to show you the consumer discretionary chart. Here it is, and the reason why that tail is so short, that's the reason why I wanted to show it to you. That shortness of that tail is coming from that very stable, you know, there is higher highs and higher lows, but they're very tiny and very close together, and makes it almost a straight line. And these distances are very short, causing momentum to go almost flat, RS ratio to stable move higher, and that's causing these short tails, which means that we are dealing with a very strong and stable trend here. We look at technology, and this is now updated to today, so we've got 1 day extra now on the RRG, and you see that technology has just moved into the leading quadrant. And if we bring technology here, we see that it is inside weakening and has now turned back up. So again, that erratic movement here, you see that this rotation for technology over the last 15, 20 days, you see that that is now pushing or pulling technology back up. So we have technology as the second strongest sector after discretionary on the RS ratio scale on the weekly RRG, inside weakening, rolling up with the daily tail just coming out of lagging into improving. I think that is a very strong structure on the RRG, and we will see that confirmed when we look at the price chart for technology, where we've seen that decline coming off that high. It was pretty vicious, it was pretty strong, but we seem to be holding in a support area around 110, and we're bouncing rapidly off that support area higher. It's only 1 day of price performance yet, but so far it's looking good. And if you look at that relative strength line, that is still following that pattern of higher highs and higher lows. The RS ratio line is coming off a little bit. You see momentum leveling off a little bit, but you know, given the level of that RS ratio, it's still super high, and that indicates that that strong relative uptrend is still there. It's still intact. If we go, I want to show you communication services, because that's the other one that is inside weakening, but on the right hand side of the weekly. Here also you see a strange hook. These hooks are the result of those erratic rotations on the daily RRG. So you see that those erratic moves, like XLC also came into the lagging quadrant and almost immediately started to move up and move higher. These very short turns are now taking its toll on the weekly tails as well, where you see XLC hooking. You know, first went up, now went down, and now it's actually 1, 2, 1, 2. So the last 2-3 weeks are very close together for communication services as well, which means that, you know, the negative heading is losing its strength, and that's what we see here on the daily tail. That is starting to pick up momentum despite the fact that it is inside the lagging quadrant. And if we bring that onto the regular chart, then we see XLC also after the break coming off its highs and now finding support that is just above 56, well, almost 57, 56 and a half area. That's where we had this previous highs. We had this high-low rotation here, and now it's another support level. Relative strength on the weekly scale is more sideways. I was expecting this to break higher above this horizontal level. Seemingly it needs a little bit more time there, and these pointing down is the reason for XLC to not yet have curled back up inside the leading quadrant. If we quickly move over to the weak stuff, then we've already discussed energy. on the daily RRG, you see the tail inside the improving quadrant, short and already rolling over, and that is more than confirmed on the weekly tail, where you see energy. You see this is a crazy move. We saw that moving higher, and now it's making that. Let me zoom in on that a little bit, and you can see how weird that move actually was. So we went down and went tuck up, down, and now down again. So we have one up week, and now it's sharply down again. So I actually expect energy to roll over inside improving and rapidly move back to the lagging quadrant, following the weekly tail of the energy sector. And the other one that's not looking too good is the healthcare sector. Healthcare is, just like XLC moved into lagging, started to move up, we saw XLV move into leading and almost immediately start to move down, together with a bunch of other sectors. And if we look at the weekly, it's now actually turned left again, deteriorating further. So we do have more weakness in the healthcare sector coming up here, and that is strengthened by the loss of relative momentum on the daily tail. If we quickly look at the charts for especially the energy chart, is very interesting to keep an eye on, because if you look at that falling trend line here, we saw all these lower highs, and then we discussed it on the show here, the break of that previous low and the acceleration lower still being pressured by that falling resistance line. And a similar picture goes for the relative strength that breaks to new lows, and you see now that the RS ratio line has put in a new low below 100, just like it did here, and RS momentum is once again pushing lower. So I don't expect a lot of fireworks. Well, maybe I do expect a lot of fireworks for the energy sector, but then it will be on the way down. If we finish off this segment with the healthcare sector, then we see that it actually did break higher, but it is failing. Well, last week it failed to hold. So far today it's back above that level, but if you compare it to the bounces that we saw on communication services, on technology, on discretionary, then this is just on the chart you can see that it is less strong than the moves that we see in technologies and communication services. If we look at the relative strength line here, you see that that rhythm of lower highs and lower lows is still intact, and that is confirmed by the further deterioration of the RRG line. So be careful with the healthcare and energy sectors from this RRG perspective. We're going to go to a quick break right now. Stay with us, and after that we're going to look at the seasonality, because it's almost the end of September and we're heading into October, so it's time to check out what these seasonal performances have been for that month. And welcome back. As you know, and as you're used to, at the end of the month we're going to be looking ahead into the seasonal performance of the various sectors going into the new month. And at the moment that means that we're leaving September and moving into October. What you see here on the screen is the seasonality spreadsheet that I have shared already with a lot of people, and I use this to get a handle on what might happen going forward based on the seasonal performances over the last 20 years when the data is available. We're looking at October right now. If we look at the table here, then the way we read this is that SPY, so the market, the S&P, was up almost 70% of the time over the last 20 years. So that's a pretty good track record for the market as a whole going into October. Now, the numbers for the sectors are actual outperformances versus SPY. So we're looking for really high or really low numbers. And if we look at high numbers, then we can see that there is one that stands out, and that's technology here at 79, almost 80% of the months of October over the last 20 years. Over the last 20 months of October, almost 80% of the time, technology outperformed the S&P 500. And if we look at other sectors, then the next best one is actually communication services, with 58% of the October months outperforming the S&P 500. So XLC and XLK, once again, we talked about it in the introduction and in the overview, they're looking good. They're actually picking up on the daily chart, and they're still on the right-hand side on the weekly chart. And now it looks as if we're getting a boost from the seasonal figures for those two sectors as well. That makes it very interesting. I'm also interested in very low numbers, because that means that in general those sectors are likely to underperform the S&P 500 in that month. And then we have two that stand out, and that's energy with 37%, and the other one is healthcare with 32%. That means that in this case 68, and in this case 63% of the months of October, energy underperformed the S&P 500 and healthcare underperformed the S&P 500. Now, as a quick little addition and tool, because this is the month of October and these are the bars that represent that, you can actually highlight that in this spreadsheet. You can do it, basically you can do it two ways. You can select the categories, so that's the category in this case is the month of October. If you hover over it, you will see that line of bars, and it now becomes much clearer which sectors are on the high number. So you got that high bar for technology, and you got the high bar for communication services, which is actually the third bar, that gray one. The first one is SPY, that blue one, and then you got the copper orange one, that's materials, and then the gray one, the third one, that's communication services. But we can also select those. So if we tick this off and we just select October and we say apply, then we got a pretty handy picture which allows us to focus and to zoom in on what's happening in the month of October. And then we can clearly see communication services here at almost 60%, and we see XLK here at almost 80%. And you can see the numbers in the table right here. Now let me put that back to all. Another interesting observation that you can make from this spreadsheet, and we're going to move to the next step, and that shows the relative over or underperformance for those sectors. And again, we're interested in what's happening in the month of October, and we can highlight that. So let me add SPY here just to be clear, because the expected return for the S&P, that's absolute seasonal, is 1.3%. So SPY market is expected to go up. It's about almost 70% of the time SPY went up in October. And during those months, so in the month of October, so during all months, not only the ones that's going up, the market returned 1.3%. Now, if we now zoom in on the sectors that we just discussed, and I'm going to highlight them again here, that's easier. So let's do October, and then we apply here, and then you can see that now it becomes very interesting, because we can see that communication services is on average up 1.3%, which is pretty interesting. That's that gray bar here. That's communication services. And then we have technology. That's the big one over there. That's 2.2%, and it's almost 80% of the time it's up. So these odds are pretty good for technology going into October. And then we had energy, which is on average down 90 basis points in the month of October. And we've got healthcare, which is also down on average 90 basis points in October. So those are odds that are really pointing us to underperformance for healthcare and energy, and outperformance for communication services and technology. Let me put that back here. Let me put them all back. And we're going to wrap it up here with a few charts. And let me bring this one back here. So we were looking at technology, which is in the weakening quadrant, but hooking up, going back up. And we see the price of technology bouncing off that support level in the 110 area and moving higher. So that's sort of aligning with that seasonal pattern. That's good. And then we have communication services, which is still in weakening, shortening the velocity. So it's not yet turning up, but seasonality suggests that XLC will have a good month in the month of October. And we'll see a similar pattern as we saw with technology, where communication services is testing resistance in that 56.5, 57 area and bouncing higher. So from a seasonal point of view, we can expect this to move higher and this to turn back up. And then on the other side, we have the weakness of energy that we already discussed. And we can put that on the price chart. And this one we've already seen. That's going down, that's pressured down. Breaking of support and relative strength, and that's backed up by a weak seasonal pattern. And then finally we've got the healthcare sector, and where is healthcare? That's right here, moving to the left on the RRG. And if we put that onto a price chart, and here is the healthcare sector, where last week it failed. Now we seem to have trouble. So today we didn't, we closed at the low end of the bar. This is the first day of the week, so this weekly bar needs a little bit more work. But look at that relative strength. That's still showing lower highs and lower lows. So the seasonal patterns right now are confirming the rotations that we see on the RRG, and it matches with the charts. So I'm actually going to be on the lookout for a strong performance of technology and communication services. I can expect those two sectors to drive the S&P higher, which is also in for a good month based on seasonality. And we're going to stay away from energy and healthcare. Both sectors are expected to underperform the S&P 500 by 90 basis points this month. And this wraps up Sector Spotlight for today. Thank you for watching. If you liked the video, please give it a thumbs up. If you have any questions or remarks, please put those in the comment section and I will respond there as well. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern, with replays on the StockCharts YouTube channel. For now, please stay safe, and I hope to see you again next week for a new episode of Sector Spotlight.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.